Nuburu Inc., trading under the ticker symbol BURU on the NYSE American, is currently priced at $0.24 per share, reflecting a strong intraday gain of $0.022 or 9.93% as of the latest reading on November 28th. Now, the common expectation here is that any micro-cap name that spikes 10% is likely moving on pure volume and short-term speculative noise, especially given the stock's significant drop from its 52-week high near $1. However, the reality is that this particular surge is backed by a quiet but strategic operational pivot that is fundamentally changing the company's business focus, moving it away from being a pure-play blue laser manufacturer toward becoming a defense and technology holding platform. This unexpected shift, which we are seeing play out in the daily chart's sharp late-morning climb, is what demands a deeper look beyond the simple price fluctuation. For a long time, the investor community understood Nuburu as a promising yet capital-intensive player in industrial blue laser technology. The expectation was always tied to their core intellectual property: high-power, high-brightness blue lasers that offer distinct advantages for processing highly reflective metals like copper and aluminum, critical in e-mobility, battery manufacturing, and 3D printing. The logic was sound. If the world is electrifying, blue lasers offer superior, spatter-free welding for components like bus bars and battery connections. The problem, the reality that set expectations low, was the slow commercialization, the significant revenue gap, reporting just $9.3K in a recent quarter, and the constant need for dilution through equity offerings to fund operations. The market saw a great technology trapped in a precarious financial structure. This tension between highly valuable patented technology and its struggle to scale commercially is what has driven the stock to the low teens of $1, far below the $10 per share valuation it held during its SPAC merger. The deeper take that is fueling this current volume and price action lies in the transformation plan announced over the past few months. Nuburu is no longer just a laser company. The strategy, spearheaded by the new executive leadership, is to utilize its public listing and technology base to acquire and integrate complementary defense tech and critical infrastructure resilience businesses. Specifically, the company has executed on the first phase of an acquisition of an Italian software company, Orbit SRL, which plays in the operational resilience software space, and has advanced a partnership with Techni SPA, focusing on military drones and defense cooperation in Europe. This shift represents a fundamental re-rating potential. The narrative changes from a struggling industrial manufacturer to a defense and technology aggregator, a sector that often commands higher valuations and has more immediate government contract revenue potential. The reaction you're seeing today, that near 10% pop, is the market finally paying attention to the operational execution of this pivot, recognizing that a small, albeit strategic, capital injection into the Italian entities and the execution of the first tranche of the Techne financial program are tangible steps away from the cash burn of a pure R&D industrial startup. Looking closer at the technicals, the recent upward pressure has been supported by a rise in volume, which is a key technical signal indicating conviction behind the price change, unlike prior spikes that quickly faded. The daily trading range has been highly volatile, with the stock moving over 16% between its high and low in recent sessions. This volatility is typical of a deeply discounted stock with a small float undergoing a massive strategic change. The short-term moving average suggests a buy signal, though the long-term averages remain a strong sell signal, highlighting the battle between short-term momentum traders capitalizing on news flow and long-term investors still anchored to the poor financial performance history. a critical resistance level sits near the 0.30 to 0.31 mark, which aligns with the former long-term average resistance, and a decisive break above that is what the momentum traders are looking for as confirmation of a true trend change rather than a dead cat bounce. This brings us to the elephant in the room for heavily shorted stocks: short-selling awareness and pressure. BURU, like many stocks in its price range, is under significant short-seller scrutiny, but the overall short picture suggests opportunity for volatility more than an existential crisis. The official short interest data is not excessively high as a percentage of the float, recently sitting around 4.12%, but the short volume ratio, which includes dark pool data, has been notably high on recent down days, occasionally exceeding 50%. This suggests active daily bearish bets being placed by algorithmic and institutional short sellers who are capitalizing on the constant risk of further equity dilution and the weak fundamentals, especially the negative working capital and significant net losses. The days to cover ratio is extremely low, hovering under 1 day, which technically means a short squeeze is not imminent and the shorts could cover easily. However, this is a penny stock phenomenon, where low float and low volume can quickly be overwhelmed by a sudden influx of retail interest or a major institutional buy, turning a low days to cover into a temporary squeeze. Retail investors should keep a close eye on the short borrow rate, which has been in flux. A sharp, sustained spike in the borrow rate would signal that the cost of holding a short position is rising dramatically, an actionable insight that often precedes short covering activity and warrants attention. Institutional holders, including firms like UBS Group and Vanguard, have been increasing their positions, albeit from a small base, which is a contrarian sign of professional investors seeing long-term value in the defense tech pivot, and this accumulation helps absorb some of the selling pressure from short sellers. The business model, which is now two-pronged, is crucial to understand. The blue laser unit, while technically advanced, faces the headwinds of long industrial sales cycles and capital-intensive manufacturing. This is the reality that shorts are focused on: virtually non-existent revenue against high operating expenses. The new expectation, the one fueling the price rise, is the defense tech vertical. By acquiring stakes in companies like Orbit and partnering with Techne, Nuburu is attempting to bypass the slow ramp-up of its laser business by generating more immediate and higher-margin defense revenue. This approach transforms the company's risk profile from a deep tech manufacturer to a systems integrator and software provider for critical sectors, which is a strategic maneuver designed to protect its listing and buy time for the laser technology to mature. The market is slowly realizing that the focus has shifted from the slow burn of laser commercialization to the strategic aggregation of defense assets, a move that could allow the company to survive its current financial distress. Moving into the future outlook, there are several catalysts and risks. The primary catalyst is the successful integration of the European defense assets and the realization of initial billings in the fourth quarter as projected by management. Any confirmed contract wins or further execution of the Techne joint venture, especially regarding the planned military drone initiatives, would likely drive further positive momentum. The highest risk, and what shorts are banking on, remains the company's financial structure and continued listing compliance. The NYSE American accepted its plan for compliance, but the company must execute to maintain its status. Furthermore, the defense acquisition strategy is reliant on complex international agreements, like Italy's Golden Power Review, which introduces geopolitical and regulatory risk. If the deals fall through or the integration stalls, the stock will snap back to its previous fundamentals. This is the essential conflict investors must reconcile: a high-risk gamble on a management team executing a complicated multi-continent pivot versus the certainty of negative cash flow from its legacy business. The retail sentiment on forums is a mixed bag, with many discussing the high volatility and potential for a pump and dump on the one hand, and others genuinely excited about the defense tech angle, particularly the drone component. There's a lot of call for transparency regarding the specifics of the defense contracts. As an investor, if you are looking to get involved, the best approach is to follow the money and the news flow. Monitor the Form 4 filings for insider activity, which has been positive, indicating management confidence. Crucially, watch the volume and price movement in the coming weeks. A break and consolidation above the 0.30 resistance level would signal a true breakout, while a drop back to the 0.20 support level suggests the initial rally has faded. For short-selling awareness, look for the next short interest report update to see if the total number of shares short has changed, and always check the real-time